You're listening to the financial capital of the West, Irongate Global Advisors. Hello, my friends. Brett Patterson coming at you from the financial capital of the West, the land bountiful. We're coming live from the studio for the first time in a long time with the man from up north, El Presidente, Spencer Nelson. Great to see your face, Spencer.
Hola, ¿cómo estás?
Muy bien, muy bien.
Bien, good to be here.
Yeah, we're speaking Spanish now.
Somos un equipo.
That's the length of my Spanish right there.
You did great.
Muy bien. Chairman.
How you doing?
Oh, I'm excited for this podcast. I'm actually very optimistic in the world in which we live. And we're going to talk about why optimism always wins. But that's later, Spencer. Keep smiling. There we go. Let's start, as always, with a market update. And then we're going to get into AI and the fear and the good and the bad and the ugly and a battle in the world of AI happening right now. But first, the markets. Year to date, as I speak, the Fed just came out with the interest rates unched.
Yeah.
Which means unchanged.
Unchanged.
Yes, thank you. Sometimes we throw market speak in.
Unched.
Thanks for the interpretation.
That's unchanged.
Just being efficient with our term.
Fed funds. Fed funds unched. The NASDAQ is up on the year 9.6%. The S&P 8.2%. But the NASDAQ is down from its highs 10%. We are in correction mode. A correction's 10%, as defined by our friends at CNBC, who aren't really our friends.
You have good friends at CNBC.
I do. I love them. So we have had a pullback. In fact, if you track certain areas of the market, there's an ETF called DRAM. That's its ticker symbol, DRAM. It's memory stocks. It's down 43% from its highs. The momentum ETF. And let me define momentum. And this is going to be a very simple definition of momentum stocks. Momentum stocks are all the stocks that go higher that people say, why didn't you buy, Brian? Yeah. Those are the momentum stocks. The SanDisk, the Seagates, anything that's going higher.
Why didn't I buy that?
Silver was one of those momentum areas last year. Remember silver went bazooka and then just got annihilated?
Silver and gold last year, yeah.
That's momentum.
Yeah.
Well, momentum, the ETF that tracks momentum stocks, is down 20%. And according to Goldman Sachs, it's the fastest fall that we've ever seen in momentum names. So there's a lot of volatility in the market right now. The war, obviously, is causing some of that, which is no bueno.
Not good.
Unless you're an options trader and you want the volatility.
Volatility or an oil trader. I guess there's been a lot of volatility in oil.
A lot of volatility in oil and interest rates and everything else. And this is a friendly reminder. The market can't go up all the time, Spencer. I know you think that, but it can't go up all the time. It's volatile.
I typically don't like it when it goes up all the time. It's not healthy.
Yes.
There needs to be volatility, but
why does there need to be volatility?
There's buyers and sellers are important to come into the market, and volatility brings buyers and sellers, so it brings liquidity to the market. And then in addition, I think when it just goes up, people are overly discounting risk, because there is always risk out there, risk is the permanent loss of capital, and there is always risk in the market. And I think when it just goes up and up and up, people forget that.
Well, and it makes our job especially hard as we're trying to deploy capital with reason and with thoughtfulness, and to buy assets at reasonable prices. When stocks always go up and just continue to go up, it's very hard to identify good investment opportunities.
Yeah.
So South Korea is an example of that right now. Yesterday alone, the market fell 11%. Total leverage in the country, the way they track it, is 200% of GDP right now. The government is coming out and saying, time out, we need margin limits.
Yeah, and there probably
That's what's
are.
happening.
I don't know the Korean market well enough. I do know that there's been a lot of foreign investment in Korea. There's been a lot of American hedge funds and money managers in the last 6 to 12 months piling in and benefiting from that. And yeah,
Crazy. A lot of memory names there, which is the DRAM, right?
Yeah, back to momentum. Right?
What's the Hynix?
SK Hynix.
Hynix
just
yeah.
became public. That's been a huge South Korean company, but their market is bananas.
Yeah, bananas.
It's up and down
but
10, 15% every day.
The Journal had a great article. You could go buy it same ownership of the company. You could go buy it in South Korea or buy it in
the ADR. No.
And the ADR, I can't remember the exact percentage. Don't quote me on this, but it's like 40% more expensive
Premium.
than the stock itself. So go to Korea.
Don't go to Korea, my friends, but just remember.
Yeah, why not? Why you don't like
I guess
Korea?
you could go eat some
Get
kimchi.
some kimchi.
Yeah,
go. I had some buddies go to Korea, eat some kimchi, go to the bathhouses, the Korean bathhouses. They love it. Yeah.
Okay.
Don't act like you don't know.
All right, moving from bathhouses to the reminder that volatility is the price you pay for returns, and you cannot expect lower left to upper right in a straight line, and we're seeing that right now. And we are in the midst of earnings seasons. We had one mega cap last week, Google, come out with earnings. We've got more this week, Amazon, Meta, Microsoft, Apple. Good night. It's going to be a fun afternoon.
It's a big day.
It's a big, big day. Brian.
Yes, sir.
Google earnings. Good, bad, ugly.
They were great. They're better than good.
Wait. That's not what I heard on CNBC. I heard they were bad.
No, they were very, very good. The stock was down. I think the reason the stock is down is investors are concerned about capital expenditures and the aggressiveness of these big companies that are spending lots of money on capital and wondering if investors are going to get a return on those investments. And so that's where the concern is. I think that's why the stock was down, because they raised their capital expenditures
Not even that much.
Not a whole lot, but
like $20 billion.
But let me dig a little deeper. And what did that do to their free cash flow?
Okay, yeah.
That ultimately, to me, is the story. It is the capital expenditure that's causing it, but what did it do to their free cash flow?
For the first time in years, Google's free cash flow was negative this last quarter, right?
Yeah. And so that's where, that to me, because as you're valuing a company, what are you looking at?
Yeah, free cash
flow.
Right.
Now get into the nuance, and we've talked about this a lot, maintenance versus growth capital expenditure, and you're not thinking that their free cash flow is going to be negative forever, right?
Right.
But talk a little bit about that.
Right. So there's, as Spencer said, there's two specific types of capital expenditures. There's capital expenditures to maintain the business, and that's to replace a part or replace something, some sort of part of the business that just needs maintenance to maintain the business, to keep the business going. And then there's capital expenditures that to grow the business. And I think Google, in the case of Google, they would argue that most, if not, I wouldn't say all, but most of their CapEx is growth CapEx.
But still on the surface, and when you look at their financials and you see negative free cash flow,
for sure,
that's going to spook some investors.
It spooked a lot of investors, which is where the opportunity is. And it's not just in Google, it's in other names. Here's the answer to the question. Will we see a return on that in growth CapEx, right? Go ahead.
Yeah, if you listen to, it's not. I'm forgetting his name. Sundar Pichai. If you listen to him, he would say that he was asked the very first question from an analyst in their conference call was on that topic, and he said he's more confident today than he was a year ago that these investments that are making, the capital expenditures that are making today, that they will see a return, and they are seeing a return on those investments. And so, in fact, if you look at data center growth, was up 86% year over year. I mean, it was incredible growth.
That's crazy.
Yeah.
Okay, so are we seeing a return on the CapEx that which we're, that all the spend is about, right? And we go back to a podcast we did months ago, which was the cake, the AI cake. And we said we like the hyperscalers, which is Meta, Microsoft, Alphabet, Amazon. And here's why we like them, because the cloud is where the data needs to be stored. That's part of the computing power, and we like it. And Google said 86% year over year growth on the cloud. But what did they say about demand?
They can't meet demand. That there's more demand than that they can supply, and that they are investing into that demand, investing into that growth, and investing in and listening to their customers saying, we want more compute. And so they're investing to provide that compute for their customers.
They've got more demand. The clients that they have right now are using 50% more compute than they thought they would, and they can't, like, they've got a list of clients that are potential clients that want more, they can't even fulfill on the demand.
Right. And that's consistent across the board. If you listen to all the big hyperscalers out there, they're all saying the same thing. Andy Jassy last quarter, Amazon hasn't reported this quarter, but last quarter, that's exactly what he was saying.
So you have Meta and Microsoft, which will report, and it'll be a similar story, I'm guessing, although we'll find out for sure. But historically, you have Meta, which has a 25 to 30% average return on invested capital. Microsoft, 25%. Alphabet, 30%. Amazon, it's 12%.
And these are incredible.
You gonna bet against that?
Yeah, I mean, if you can get 20+% return on capital, those are great businesses. You want to invest in those kind of businesses.
That's why I love the market.
There's always a debate. I mean, that's why we have markets. There's always the bear and the bull and the debate out there, and that's what makes markets.
And it pays El Presidente to be optimist.
To be an optimist.
Thank you. I'm excited for the earnings. Stay tuned. But I love Google. I mean, good night. 86% return year over year. That's pretty amazing.
But it's funny how the narrative has shifted on Google. Remember, for the previous 3+ years,
100%.
everybody was talking about
the
death of Google. Google search is gone. And then about, I don't know, it's been a year now that that kind of the narrative flipped on
Sergey's
Google.
back in the office.
And Google's up 80% over the last year or something like that.
And
it was.
I love
65,
65. It was up 80. It's pulled back. It's pulled back some.
Because of the negative free cash flow.
But, we stayed with Google. Why? Partly because listening to these conference calls, listening to Sundar, he remained bullish on the business.
Yep.
And
this is not a recommendation.
No, yeah. I mean,
Thank you, compliance.
This is for entertainment, only.
Purposes only. Yeah, these aren't recommendations.
I think you're very entertaining.
But shifting that to just the AI space in general. And this you watch CNBC, nobody's even talking about this, but it is huge right now what's happening. And that is a debate over open or closed AI. Jensen, the great CEO of NVIDIA, he got on X, formerly known as Twitter, and he opened a profile, and he made his first X post. Is that what we call him?
Sure. Yeah.
X post. And he said, here's why I'm an advocate of opened AI versus closed. But let's stop right there. And he went on and he talked about why he's an advocate of opening everything up, right? But what is the difference between open and closed AI? Let's define that, and then let's continue the conversation.
I think I have a pretty good analogy to that, and it's like a recipe. Let's say you had the recipe for like the best banana cream pie, Spencer, out there.
Ooh. I'd be interested.
And and you didn't share that with anybody. That would be a proprietary, or I would call it a closed recipe, or in the case of AI, a closed model. And in the opposite of that would be, okay, you have the recipe, the greatest banana cream pie recipe in the world, but you share it with everybody. And then everybody can go out and make small adjustments if they want, but the recipe is open. Well, in closed models, that recipe is not known. For example, Anthropic, OpenAI, even Gemini, Google's these are closed models. They don't share with everybody, how their models work. They're proprietary. But an open model is like this Kimi K3 that came out of China recently. That's an open model, and developers can go in there and adjust it, make changes, and the recipe is known, and everybody can go out and use it. That's an open model. So those are kind of the differences between the two.
Perfect. Love it. So in China right now, it's all open models, right? Which is threatening U.S. companies, Anthropic, OpenAI, and other models. And those models are fearful of, hey, they're stealing our information. Right? So there's this big debate going on within the AI space and technology of what do we want? Do we want open or closed? And Jensen comes out and says, we want open. We want open because we need to share everything to create security, to create advantages for small businesses, large businesses. And he went on in this post to list all of the pros. Those are a few of those pros. But then, and so what happened in this letter is companies started signing it and saying, I agree. And Elon Musk is the first, and then Zuck and all these people. Soon, Sundar signs it. Sam Altman signs it. Yes, I want open. He's right. We want open. There's one person that hasn't signed it, and that's Anthropic.
Well, that's the guy with the banana cream pie recipe.
That's right.
He doesn't want to share.
Well, yeah, I totally, and I get it. Would you? And yeah, when you look big picture, but let's think on a very small scale. I have the banana cream pie recipe, and I am selling my pies at a premium, and no one else can come close to my pies. Kind of, but there's separation, and there's separation with Anthropic and Claude right now.
Not much.
I mean, there's some. There is. I think there's some separation there, and everyone else, all the other pie makers are saying, "Hey, give us your recipe. Let's just share recipes, right?" And I understand both sides of the coin. I do understand that part of it, and so I just think it's an interesting debate.
So here's the fear that OpenAI would have, and you're going to hear this phrase called distillation in the AI space, right? Distillation is essentially someone stealing the recipe, the banana cream recipe, and then giving it to everybody else. That's the fear.
That's what Kimi K3 allegedly has done. I think you could argue pretty strongly that's
so
the case.
These open models, really, it's like the internet. It's free to everybody. Go in as a small business, download OpenAI's model onto your servers, and make it better for your business and just use it so that you can grow your business. Now, what you're going to have to do is you're still going to have to pay OpenAI. So they're still going to make some money. And then you got to pay, what I love is the hyperscalers, because you need the cloud, right? You need the computing power, right? But Anthropic and Dario saying, we know better. We know better. No one's touching our intelligence. In fact, Dario, I know better. I'm going to DC to tell them we want closed. Now, what happens if the U.S. goes closed? They say, okay, let's regulate and let's go closed, but China's open. What happens? What's the risk in that?
Well, I think we'll fall behind the AI race eventually.
But why?
Open models is where it's open. Everybody can go out and contribute. All the smartest, brightest minds, these brilliant kids coming out of college with new ideas, they're able to go into an open model and put their, these new ideas in there. Where if you have a closed model, if you have just a few closed models, I think that's anti-competitive. Mm-hmm. I think they probably get stale. And I think we fall behind the AI race if we have a closed model system.
100%. You have a few models dictating what they believe is super intelligence, right? And if Kimi and Chinese models, look, here's the goal. The goal for customers is to get the best model at the cheapest price. So if Kimi can get you 90% of the way there and it's an open model, but it's 70% cheaper than Anthropic, what are you going to pay for?
Well, and that's really what happened is Kimi basically matched the strength of all these proprietary AI models like Gemini, Anthropic, OpenAI, but about a third of the cost. I mean, that's what's crazy. Is for a third of the cost, they have basically leapfrogged and actually have a model that's very, very competitive at
a cheaper price.
A much cheaper
At a cheaper
price.
It is similar. There's some parallels to just the DeepSeek. It just parallels to what happened there. And
So I, as Anthropic and OpenAI and any model, right, whether it be Meta, SpaceX, whatever it is, they've got to continue to stay ahead with the models that they're putting out there. But they also have to worry about price as well, right? Because the goal is the best model at the cheapest price. And you're right. If we don't open it up, China will. And all these small businesses in America are going to be using China models.
Because it's a
which
third.
who knows what the CC2
well,
is.
yeah, and that's the regulatory side. You know that they're stealing everything. You know, if it's a model,
Yeah.
it's that intellectual property and all of that kind of stuff goes out the window completely. And that's the risk. That's where business owners would have to be really selective. I mean, we're not doing that, right? There's no way we could do that.
Which Alex Karp went on CNBC and said that's what Anthropic's doing. They're taking proprietary secrets from the best companies in the world, and they're coming out. How many times over the last 3 months have you seen Claude cybersecurity, Claude tax software, Claude this, Claude that? That's what they're doing. Yeah. So it's being stolen no matter what. So there's got to be something in there.
Oh yeah, there needs to be something.
But Jensen's point is open it up. And it's going to be fascinating to see how all of this plays out.
Let me ask you, how careful does everyone need to be with having Claude?
I would say careful. Yeah, I would say anything that wants your email address and access to your personal information, wait. Just wait a while.
I think you have to be. That was one of the biggest risks I thought, and I still don't have Claude, is because I think there's a lot of risk associated with it.
Yeah, they want access to your emails. Don't do it. I don't trust Dario, man. And my opinion can change, but I listened to about 3 hours of him talking yesterday. And I don't really trust the dude.
Well, I think it's good to be
careful.
skeptical. Yeah, be careful
But the
with
beautiful
everything.
thing about the open, right, and then we'll stop talking about open versus closed, but the open is we as IronGate can download OpenAI to our own server and then use that model within our own server, not open to the world, but we can use it for our own business, whatever we need. And here's the beauty, Brian. We need to use Google Cloud or AWS or any other cloud to still do that. Goes back to what we talked about in the cake. Right. Where do we want to be in the investing cake?
The hyperscalers. I mean, it feels like all. And this can change, but absolutely it feels like all roads lead to the hyperscalers. Eventually, do you know what I'm saying?
Eventually. Yes.
They benefit from the closed models because Anthropic is a big customer of Amazon, Google, their cloud platforms, their hyperscalers. Same with Google. And they also benefit as costs go down, demand goes up. And who's going to benefit? It's the hyperscalers, because just the demand for compute is going to continue to go up.
And the cost to produce that compute, there's just so few businesses in the world that have the ability to. I mean, it goes back to, I think it was Jensen or Elon or Alex Karp, whoever it was, 3 years ago. AI is a rich man's game. And it's the Western world that has the resources that's going to be able to do it and benefit from it. But then you look at it to just get the compute, right? It takes so much money to create.
There's a handful of companies
that
in the
have
world
those resources,
that have the resources to invest in this AI
to create the compute. I mean, some small company can go do, but you have to have billions of dollars to create the computing power necessary.
Hundreds of billions.
And very few companies have that.
That's why the hyperscalers benefit from Kimmy, anybody, right? But that's also why we need more computing power, also known as data centers. I'm so sick of the anti-data center crowd.
Oh, wow.
I'm done. I'm done with it.
That's interesting.
I think that's Chinese propaganda.
Wow. I
To the fringe left and the fringe right.
Once again, I don't think we need to go fringe left or fringe right. I think everything needs to be thoughtful and responsible when it comes to data centers. I think it's good.
We need to build more. I want to build one in your backyard.
Well, that'd be great. I think that would be greght. Can I get a 2-cent per kilowatt
That would
discount?
You want a cut of the power usage.
Yeah. I just think, I mean, there's personalities that are ready, fire, aim, and there's going to be a lot of bumps in this road as the country navigates it, as companies navigate it, and I think it's important to be thoughtful and
build it out. Find the deserts, the great western deserts of Utah, and build.
Where's the energy going to come from?
So the energy that's part of the fear is that it uses too much water and hey, natural gas is in abundance, right? Use natural gas. That's in Box Elder, Utah. There's natural gas pipeline right there. Use it. And the water is very, very limited to what people think.
I haven't seen the data to reflect that yet, but I haven't seen all the data. I know the data. I haven't seen the data to reflect that. I've seen the commitments on the front ends of the data centers, but I haven't seen the data yet to show that. I don't know. Have you seen it?
I haven't seen the data, but we listened to a podcast yesterday, Brett and I, with Sam Altman, and it was actually a really good podcast. And one of the things he said is the technology today on water usage is no different. A big data center is no different than an office building, which has bathrooms and coolers and things like that. Yeah. So the technology has come along.
And I've heard all of that. I just like to see the data. We have data centers. I mean, Musk has his data center in Memphis, right? I haven't seen any published data on that usage.
So I don't have firsthand knowledge.
Well, it's published. It's just, who are you looking for the published data to come from?
Well, yeah.
You want the government, or do you want, it's out there. You just got to go find it.
I need to find the utility records I don't know if I can access that. Can I access the public utility records of the data center in Memphis, you think?
Yeah, I mean, what Trump said with data centers is the companies building it have to pay for the power. There's not 1 cent that the public will pay for as far as their rates going up, right? That's the rule behind it.
Well, but
people don't believe that.
That's the concern, right? And how does that work in a market?
Yeah, I mean, if there's a shortage of gas,
how does that work in a market?
There's no shortage of natural gas.
Hold on, but if you have a price, okay, and usage goes up, generally what will happen? Price will go up too.
You pay this Amazon or whoever in this data center.
Yeah.
Okay. The public is going to continue to pay their price. You pay your price.
It's
broken out.
I would just like to see. I haven't looked at the utility records of the Memphis thing.
And what you're saying is trust and verify, right?
Just verify. Because I don't know. Can I pull up your public utility records?
I'll give them to you if you want.
Well, no, I know, but I don't know for the public. I don't know if that's accessible information.
Yeah, there's information on all these data centers, but here's the reality. If we don't build more, China wins. Because they are building a ton. Right. So, all right, here's the next thing. Let's end on. And it's the idea of optimism. I'm going to throw a few things at you. I'm so bullish right now, guys. That doesn't surprise you. Bullish. Here's why I'm bullish.
I won't say. I'll keep my opinion.
You can share it. Right now, as I talk to you, fine gentlemen, El Presidente and the chairman, there are 167 companies spread across 37 states starting to build on a total $1.9 trillion of infrastructure. It's the reindustrialization of America that's happening right now that no one seems to talk about. The Trump administration said there's $5 trillion of commitments. I don't know. That would suggest there's $3 trillion more out there. But right now you have companies building in the U.S. for the first time because of the tariff scare. AstraZeneca, Bristol Myers. Here's a few other companies building. Micron, Nucor, Apple, AstraZeneca, Taiwan Semiconductor, Roche, Broadcom, Toyota, Chobani Yogurt, which I know you like, and the list goes, like I've got another 30 names here. That's what's happening in this country right now that somehow we've lost sight of. The reindustrialization of America. Is that bullish?
Yeah, I mean, it comes back down to, it's definitely bullish. It's bullish for jobs. It's bullish for infrastructure.
For blue-collar jobs?
Yeah.
For sure.
Yeah. And companies hopefully are investing with the idea that they're going to get a good return on those investments. And, of course, that comes back to capital expenditure and getting returns on those investments. But 100%, this is definitely bullish. And you're seeing that in, a lot of stock prices. You're seeing that in a lot of companies who are the main players in infrastructure build and suppliers. And so we're seeing that. And, yeah, that's definitely bullish.
All I know is Chobani makes more yogurt. That's a good thing. Yeah. Right, Spencer?
Yeah, I'm more of a Noosa yogurt
I don't
eater.
even know what that is.
Noosa? Oh, try it. It's very good.
It's coming from the banana cream pie
Or if we're
expert.
going, I would go to Europe, and the yogurt in Europe is very good. Mueller is very good. Mueller. But
optimism always wins out, my friends. The NASDAQ is down 10% from its highs. There's fear all over the place, especially in the AI space with these hyperscalers. We talked about it. We will see what happens. Earnings drives everything. So as long as management is making good investment decisions with this capital growth CapEx that they're spending, this is a very bullish thing for America. God bless America, Spencer.
Amen.
Hallelujah. Anything else, boys?
Yeah, you said it. Earnings drive stock prices.
Earnings drive everything.
Yeah, at the end of the day, it's not interest rate. It's not, that has an effect on the short term. But bottom line, what drives stock prices is earnings and profitability.
And I'm Brett. I'm with you. I'm bullish over the next 20 years. I just know it's not going to be a straight line to get there.
It's never a straight line.
That's a great way to end it, which is what we talked about at the beginning. Volatility creates opportunity. All right, my friends. Thanks for the conversation.
That was good.
Yeah.
Thank you.
Are you mad because I just talked about the fringe left and fringe right?
No, I'm not mad at all.
We're friends, right? Where are you? Are you a fringe leftist?
We're co-workers. Of course we're
I
friends.
love you, Spencer Nelson, El Presidente. Until next time, my friends. Bye now.